And hi, everybody. Welcome to another edition of Your Money Radio. It's just me with you and Danny Stewart live. Whenever you're listening to this, we are absolutely positively live with you. But I'll tell you what, you might think we're not live with you, but we're available to you. And what do I mean by that? You can always get a hold of us. You can call us anytime, day or night, 855-732-5932. You can get me at TJ Razor on Twitter, at @1DannyStewart on Twitter as well, or just at Dan at Revere Asset or Tim at RevereAsset.com. And that's how you can get a hold of us. I'm going to tell you, Twitter is the easiest way to get a hold of me. Danny, before we start, hello, Danny.
Hello, Tim.
Yeah, okay, before we start, I had my rundown sheet, my big old penciled in rundown sheet here that I want to talk about. And Danny doesn't know where I really want to take the show. I want to do sell-off signals that I'm looking for to get more, I'm already short the Russell and the Dow, but that would get me more short or have me selling more positions. But I've got a big, shiny, bright light object, Danny, in Netflix that I want to talk about. I want to talk about earnings stocks because Netflix reports earnings next week. And I wasn't planning on doing this today, actually. But then when I saw what Netflix was doing, I was like, you know what? We should probably do this today. And so don't focus on the bank earnings, people. Bank earnings, the banks are garbage. They're hot garbage. They're sewage. And anyone's been telling you to get into that garbage forever or you're getting paid to wait. They're sewage too, and they're garbage. And so just to see how I started out there, Dana, a little fire and brimstone, people telling you get into Wells Fargo or JPM. It's the most worthless advice ever. And so you're getting paid to wait. You're getting paid to lose. And so the only people that I know in my lifetime that have gotten paid to lose are the Washington Generals, who lost to the Harlem Globetrotters every freaking game. Actually, I think they won one. Did the Washington Generals win one, Danny?
I don't think so.
I think they did. I think
know.
they actually won one game. Okay, so here we go, which means the banks one day will win too, just not today. So here is Netflix. Let me explain to you. If you're looking, whether you're on Schwab, Fidelity, Interactive Brokers, you can look at the implied volatility, which is over here on the right-hand side of my chart, and you can kind of pick up where earnings are going to be. And how do you do that? Look for the biggest implied volatility number by percentage, and you can just kind of, you don't even have to know when earnings are, but you can see that this is almost 90% now. This has jumped up dramatically in the last couple of days. Well, earnings are next week, and so it's kind of a big deal. And so there are things you can do for earnings that make life interesting. One, if you have the stock already, that's fine. But two, if you're an options trader, this is what a lot of people won't tell you when you're going to buy options. What you don't want to do is, if you're starting a week or two out, you can buy like Delta 30 calls or maybe Delta 50 calls, okay? And you can ride those for a potential run into earnings, meaning the price goes higher. But even if price trades sideways, the implied volatility rises and it protects the premium you paid for those calls. I'm going to pause there a second. Danny, will you interpret all that very plainly for people who don't trade options?
Well, yeah. So the applied volatility is very similar to the expected move. What they think the price, the market makers, the bookies, if you will, they just want to make money, buying and selling on both sides, like the bookie when you're betting. They're going to adjust it based on how many people are buying calls or selling calls, and so they're going to adjust that line. And the applied volatility means what that expected move is going to happen. And as it goes into earnings, odds are you're going to have a surprise, either one way or the other. You don't know which, but it's going to have a big pop. And one thing that you mentioned, a lot of people that teach these option strategies tell you to buy just a couple days before earnings. Well, the price is already baked in then. You really got to do it at least a week before. Right. And what you're saying is, even if you say you buy a call, even if you buy a call and the stock goes down a little bit, normally a call would deteriorate, the price would deteriorate greatly. But because earnings are still next week, you got a potential of an upside surprise. So the price is going to hold there. It's not going to sell off.
And so here's the thing, you typically don't want to hold these calls. If you bought calls 7 to 10 days before the earnings event or the binary event, you don't know how it's going to turn out. What you don't want to do is hold the calls. you want to sell them the day of, and typically right before the earnings event, because you're going to see this number spike typically right into the earnings event. And if you see that number going down, what you want to do is get out of those calls, because your calls are going to start losing value, because the premium, there's two ways to drive price higher in a call option in a stock that's about to report earnings. Price goes up, of course, or the implied volatility increases, meaning the premium to get in increases as well. But if you see that number dropping, oh, that makes it a tough scenario. So what you want to do is you want to sell these, because what we're going to see here is, I'm going to track this with you. You're going to see this number the moment earnings are released, they report in the afternoon, so the next morning, you'll see this number get cut in half. And then as the week goes on, it drops even more and more and more. So you could have the like $550 calls for Netflix, and you can see we're trading 538 here, or the 560s or the 580s, and maybe Netflix reports and it's great and it goes all the way up to 600, but you bought the calls the day before. Like, you have to have an exponentially bigger move than this number right here, this implied volatility expected move. It's a translated dollar figure to actually make money on those calls. You're paying so much more for the calls as you get closer to the event, that the magnitude of the move higher has to be that much greater. Can you clean that up for me?
Yeah, so what Tim is saying is that expected move that he's got circled, it's either 55, 90, just call it $56 up or down, either way.
Right.
So if you buy right before the earnings event, that's already baked in. You've got to be more right than the expected move or the whisper number. So you've got, now the other thing he's saying that I want to make sure people caught that, because he said it pretty quick, is he said you want to, if you're trying to kind of make money consistently and do it over and over, rinse and repeat, he's saying you want to buy the call 10 days out, not just a couple of days before earnings. You want to buy it before, let it run up into earnings, and then normally going into the close of that day, because they report after the bell normally or the next morning, but you want to sell it, maybe 10 minutes before the close. You'll see it kind of spike up and run up, not always, but normally. And if you hold it through the close, through earnings, now you're just speculating. That's gambling. You could make a lot of money, but you could lose your whole premium all at once.
And that happens to so many people, especially that buy out of the money calls. I'll show you that the like think about this. It's trading 540 right now, Netflix. The 600s have and it's thin air, right? Because there's no intrinsic value above 540 or 539.08. So there's no intrinsic value in those calls. And so it's all just fluff or marshmallow, but it has value right now. But once the event happens, and say Netflix just trades sideways, it doesn't matter what you think is the good report or a bad report. What matters is how the market takes that information. And what the market makers are saying here, right here, is that Netflix has the ability to traverse $55 to the upside next week and $55 to the downside. That's a big wide range for Netflix right here. And so if you stay within that $55 bracket, everybody who bought out of the money calls, or conversely that bought out of the money puts, they're all going to lose their money. Danny, can you?
So look, so just round it. It's 539 right now. Let's just round it to 540. The expected move is $55. That's really 605. So if you're buying that 600 strike, even at the money, you're paying a premium. You got to recoup that premium, and it's got to get over. So it's got to get above 605 plus the premium you paid before you get that. When he says marshmallow or fluff, in Wall Street jargon, they call that blue sky. It's blue sky. It's not.
And let me be the last one to say that it can't happen. It absolutely can. It absolutely can happen. But if you're thinking in a probabilistic mindset and not a gambler's mindset, you want to be really careful there. Like, probabilities say that you're going to stay. This probability is about 70%. So you have a 30% chance of exceeding that move to the upside or the downside, a 70% chance of staying within that expected move. You want to go with the odds here. And so what happens is people get FOMO. They get the fear of missing out when they see a big move. Like today, my thought is if the market if there's not some big news event and the whole market isn't imploding on Monday, that this Netflix gets all the attention over the weekend. Traders are going to, even though you're like, well, Tim, Netflix is up. I got to move I've got the cameras, Danny, so I got to just set them over here. Netflix is up 6%. And so a lot of people will look at that and go, well, Netflix can't go any higher. I bought more calls this morning for my personal account when Netflix was 525. Like it was already up over 25 points. And I'm like, you know what? I'm adding more calls here because I know how this works. I got more we're already bullish in the shop. I got more bullish in the shop knowing how this premium expansion works. But look, it doesn't mean it's going to go straight to the moon. Or what I'm trying to get at here, Danny, what I want you to clean up is because it's up 6% doesn't mean on Monday this can't gap higher and go even higher as people anticipate the earnings. They get the fear of missing out because over the weekend all the stories are going to be Netflix up 6%. Everybody's watching Netflix. I got to get me some. Can you clean all that up for me, please?
Oh yeah, yeah. You know, the story's going to be out. We're going to close down for a few months longer. There's more cases coming up. More people will be sitting at home and binge watching, and it's going to be all the hype. And Netflix is one of those key areas that's got all the media attention. And it's one of the leading stocks. It has been a leader for the last 3 years. So people get biased in their mind. They get that behavioral finance prejudice going, and it absolutely could go higher.
And what a lot of people believe, say is that, well, there's no way it can go higher, or they get more bullish than what it is today. And they say, well, if Amazon's a $3,000 stock and Tesla's a $1,500 stock, Netflix is surely underpriced. Look, all that is nonsense. And so you just want to trade the charts in front of you. But the backstory of how all this works is what no one explains to you. Not very clearly, I don't think. And we're trying to do that every week with just defining the probabilistic mindset and the velocity of money. Do we own Netflix shares in the shop? We absolutely do. We added, like, Danny, was it 2 days ago? Hey, all the new
accounts, it transferred in that didn't own it. Yeah.
Yep, all the new accounts. And so it's strategic buying. We actually bought in a really flat range in a pullback, in a little bit of a pullback zone. Strategic buying is crucial here. There's going to be so many chasers. You don't think the move from the open was 519. It had a huge open today from, I think it was an upgrade, got down to 511. And here you are, Bob, before you know, Bob's your uncle trading 540. This will get all the attention next week. But if you want to know the truth, if you're like, well, I missed Netflix, I don't want to chase it here, you can do a number of things. But one of them that you don't want to do going into the print, Danny, I'm going to say this, and I'm going to need you to clean it up, okay?
Yeah.
One of them that you don't want to do right now or Monday, you don't want to sell a put credit spread, because you're not, with a put credit spread, you're looking for theta. Danny, I didn't mean this to be a whole option start show, but this is the stuff this is the stuff that
you just got on a run.
Yeah, and nobody talks about this stuff, and we've never done a video podcast where we're talking about earnings and I can actually show people what's going on.
Right.
And so when you sell a put credit spread, that's a bull. You're saying I'm selling a put and I'm buying a put for protection. We don't do anything. I don't do anything naked here. I don't need to. And so the only thing I do naked is with them. No, you just let that go. And so anyway. See, Danny, I restrained myself.
I was letting it sit there.
Yeah, theta. And so you want the theta to burn down, and you want to take in all that credit that you sold. But what happens is, because this implied volatility expands, you're not getting any of that. What you can do, though, a half hour, 15 minutes, 10 minutes before the actual event's about to occur, is you can absolutely positively sell at the money put credit spread. And your risk reward is pretty good, because if you sell something like a 1-to-1 risk reward put credit spread, it's defined. but two, you're looking for the bleed in fate. You're looking for the bleed in the implied volatility. So what you're doing is you're being the house. If you sell the vertical put credit spread, you're selling it to all the people who have FOMO. It's no different than when a new blackjack player comes to Vegas and thinks they're going to make a killing, and you're the savvy pro and you're going to take all their money. And so it's no different than that. You're the house. Danny, can you clear all that up about vertical put spreads there for a second?
Well, yeah. So what he's saying is, if you do a vertical put credit spread, you're selling a put that's closer at the money or wherever the strike is to take in premium, because you're selling insurance to somebody. But
Yep.
naked, it could go all the way. If the stock got crushed, you really owe a lot of money. You'll buy another put slightly below that.
Usually $5.
Yeah.
Usually $5. That's $500 worth of risk, and then minus the credit. So if you took in a $3 credit, you really have $200.
You got $2 of risk or $200, and you can pocket that.
Right.
And so it's basically you're selling time, short time in this situation, because earnings is coming up. You're selling short time, and you know how much you could possibly lose.
There you go. Perfect. So but my thought is that if you're fearing that you missed out on Netflix, like you're like, well, Tim, I want to participate in Netflix. Well, one, all of our clients are. So if you're a client, yay. Two, if you missed Netflix, and I think there's so many cynical people in the world these days. Don't be cynical. Like, somebody might have thought Netflix, the whole market was going to crash, and it hasn't, and now they want to participate to the long side, but they fear it's too late. It's a real thing. Danny, I'm going to cough. Give me 1 second.
Well, one thing I'd like to mention, because you were mentioning about it can't go higher. Higher. Just remember, it wasn't that long ago. Well, it was a little longer than a couple months, but just a little while ago, Amazon was $2,000, not $3,000, and people were going, "Wow, it's $2,000. I better take." It can't go higher. It can't go higher. It's 50% higher now.
So, but I think what the play is Amazon. Danny didn't know I was going to say that. So if Netflix reports a good quarter, or just they trade sideways, the play is most likely Amazon. I've done this earnings season after earnings season where I'll sell, I've got stock, but I've also got calls, and I want to roll those calls. Well, I'll take the money from the calls, win, lose, or draw, and then I'll go play Amazon, because that's typically the play. And so when you see, and you're like, well, Tim, what's the strategy there? It's the FANG rally is what it is. It doesn't always work like that, but I've seen it enough times where you can sell the Netflix calls, go to the Amazon calls, or go to Amazon stock, or go even to Facebook stock, and that's typically the play. But it doesn't have to be like this. This market is following no one's playbook this year. I don't know if anyone's been paying attention. So,
right.
So that's, gosh, I didn't think. Let me look at my cheat sheet, Danny. That was.
And by the way, everybody's talking about, or all the people on Wall Street talking about the market coming. Oh, look at this. We've already come off the bottom. Remember, the S&P is still negative for the year.
Yep.
It has not gotten green yet.
Now, we're not negative at Revere. We are.
No, not at all. Not at all.
Not at all.
But the S&P is negative. Now the NASDAQ is doing very well, and that goes to your point. There's certain stocks and certain sectors, the Amazons and Netflix, that are doing fine, and they're doing fine in this environment. There are other stocks that are absolutely underwater, in trouble. And by the way, bankruptcies are on the rise. You got lots of companies that are, going bankrupt. This is a stock picker's market right now. This is not an indexer market.
Let's do this. I want to do sell-off signals on. I want to cover sell-off signals, but before I do that, real quickly, stock nerds and market lovers, where are my manners? I want to introduce you real quick to our website, and I want to just show you a couple things. If you're watching this video, you already know this, or if you're watching it early, but if you waited to get this video, what I want to show you is if you go to Daily Market Insight, on Fridays, we post 2 videos. So you'll get the video podcast and the normal weekend video, and I've got both of those today. But you don't have to wait for it to post, the video podcast to post in the podcast page, which comes out normally Saturday morning, and we upload to iTunes or the Apple Play Store Apple Podcast Store, and the Google Play Store on Saturday morning. So you can get it early, get 24 hours
Are
early.
we on Nintendo yet?
What's that?
I said, are we on Nintendo yet?
Not yet. And then we can get the contact us page here. If you have any questions about what I'm talking about, look, just email me over the weekend, tim@revereasset.com. Here's the portfolio extraordinaire who's taking a little bit of a break. Don Vanderboord knocking the cover off the ball. And then here is America's fiduciary who is cutting through the clutter of all my talk, Danny Stewart. And then look, 855-732-5932. If you like the strategies to which we espouse, all you have to do is give us a call. Call us on the weekends. We're here. You can email us. I tell people all the time, I do it in the nightly videos. If you want to get a hold of me and you want an answer quickly, like a little more timely, don't do email. Emails get long, my inbox clogs up, and some of you have detailed questions. There's nothing wrong with a detailed question. I often take detailed questions and I address them in the videos. But if you'll write me a detailed question, one, I'll never give you advice, okay? Like if you're saying, what should I do? I will show you a fact-based approach in a video that how I would handle XYZ situation. So it's broadcasting to many, not just one person, but I will never give you advice, but you can get quicker answers to your questions or the rules that we talk about, especially earnings and all that option stuff that I talked about. Follow me on Twitter @TJRazor and then let me know you followed me. Shoot me, you can then direct message me right here and you can do the same thing to Danny. And so Danny is right here, one Danny Stewart, and then just let Danny know that you followed him. And then you can just hit this button here on the app on the phone. It's just the message button in the bottom right hand corner of your screen, and you can shoot Danny private messages as well, and he'll get back to you quickly. Or if it warrants a phone call, he can even call you. But Twitter is the best thing since Twitter is the next best thing for us to texting, and I stopped giving out my number a long time ago. It just got so much. Look, I love the stock nerds and market lovers, but my phone was becoming was just constantly going. And so, does it constantly go with Twitter? It does, but that's fine because I can just mute the app for a little bit if I don't want to see all the dings or alerts. Does that make sense, Danny? What I just said there?
Absolutely.
Got it cleared up. Okay, so look.
And also Don is D at
D Vanderboord. Yep, Don's on Twitter as well. And then look, if you like these strategies, give us a holler. Look, even if you have questions or you have a loved one and you're like, how can I help someone who's missed out on this? How can I help someone that is 100% all in? I'm about to do sell-off signals here that we're looking for that would get me to sell a majority of the portfolio, maybe get me a little bit more short. Give them our information. Most people, they watch the videos for a number of months, and the typical fashion is then they explore coming on board, and then maybe a month or two later they come on board. We'd love it if you came on board. We'd love it if you joined the family, and if you don't, just call and ask your questions. You're not going to get spammed. We don't have anybody selling you. By the way, anybody selling you products, we don't have salespeople. We don't need them. I want to show you this because I can come off as bearish, but I covered a little bit of timing for a market sell-off in last night's video. And then right here, buy the breakout. And so the two stocks we added, right? Like the party is over for this popular stock. That was Nikola a couple days ago, but you can see there's an undertone here of bullishness, right? This chart will destroy some dreams. The stock we added today. So let me show you what I mean by that, the juxtaposition of those sentences. And so this is the chart that's going to cause people a bunch of tears. If you are someone with a 401k IRA, or you're just a trader with a cash account, and you're 100% in all the time because of rules, or you just don't know what to do, this is a big deal what's happening right here. The low put call ratio insinuates that what you've got is everybody buying calls right now. That means everybody's uber bullish. I'm sorry I keep moving the charts on you, Danny. And I apologize to the stock nerds too. I've got a question, Tim. Why do you keep adjusting the charts every time you're talking? Because when I talk on a chart, I lose the camera and I can't see. It makes it better when I can see someone when I'm talking to them. Does that make sense? Yeah. So anyway, what I'm looking at here is a put call ratio, 10-day moving average, that blue line that is pointing lower. I mean, just look at how low this is. The last time it was doing this was over here the beginning of June, and this gap right there was that huge 1,800 point drop in the Dow. That was what that gap is. And so you've got the zone of complacency down here. Everybody's bullish. You've got this 10-day moving average pointing lower. And it's just telling you to be careful. It's telling you to watch your size, meaning if you normally take, look, we take 5% stock positions, 10% ETF positions, but lately I've been doing if you've been following along, 2.5%, because sometimes I'll buy stocks in pairs when I don't know which one's going to work. And I've just been working, like in small position size, cutting losses real quick. And I sold Boeing. We're going to know what I did this week with sold Boeing for a small loss. And I've got some things I want to take profits on here during the show. But use position sizing as your weapon. 2.5%, 5%, 10%, they can't hurt you if you don't let them run. If you don't let your losers run, like I try to nip them single digit. I want to keep them 8% in an uptrend, which is what we're in, or 5% or less in a sideways to downtrendy market. If you let things run 20%, 25%, 30%, it does make it harder on you. But even if you don't have the courage of your convictions to take your losses, using smaller position sizing cushions the blow. But some of you have got 50% of your account in Amazon. And I get it, man. It seems to want to go up every day, but there's going to come a day where it loses 5% of its value in a day or over the course of 2 days. It's up 10% this week, Danny. Amazon's up 10% this week. So if you're leveraged long and you've got 110% of your account in Amazon, you're having a great week. And I don't begrudge you. You're never going to hear me talk down to people making money in the markets. But it's those down days that I think you want to I know they're out there, but it's hard to tame the trading beast when you're winning. And so today's a great day for Revere. Today's a great week for Revere. And it feels good, but those feelings of, those emotional feelings of, that's just the endorphins kicking in, and you want to be able to turn those off. And turning those off starts with trading position size and not letting your start. How many of you trade and you go, oh, that's the swimming pool I want to put in. If I just let this trade work, I can then afford the RV that I want to buy and all this other stuff. And that's called trading with an agenda. And that gets into a whole big psychological issue. And you just want to be free. And position sizing allows you to be mentally free. You agree?
Yep.
Yep.
I've seen it. I've seen it over and over.
Yeah.
I've seen it over and over. And I've got people reaching out to me this week, being very, I want to say, bullish. They're very ecstatic right now because they're going, I've made so much money this last month or two. It's been great. I've really done well. And I said, yes, and you should have. We have too. Now, what's the plan when it changes?
Yeah, and we've done it.
Continue to do this right now, but the one thing I do know is it will change. I don't know whether it's 2 days, 2 weeks, or 2 months, or 2 years, but it's going to happen, and you have to have a predefined plan in place in advance so that when it does happen, you don't give all the gains back.
And this chart's telling you, it's not telling you when, it's telling you that it's coming. And so if you understand that, then you can keep the velocity of money always moving forward. And so I sell a lot of my winners. And as a matter of fact, let me just do some sell-off signals. I need to finish this, or before I get into keeping the velocity of money going forward. I sell a lot of my winners, and some of you wonder, why you sell winners? Why you sell your winners? Because I would rather reduce my risk. I reduce my risk by entering a new position towards the mean at its point of least risk. And so I can sell something that may be extended, wrap up anywhere, it doesn't matter what the gain is, wrap up the gain, and then reduce my risk by entering a new position if I see my setup. And that's a key phrase there called seeing your setup. Do you know, Jesus, Danny, did you see this? I just took it off Netflix for a minute. Holy Hannah.
Oh, now it's at 87?
No, Netflix is at 547.
Oh, no, I was talking about the applied volatility over there. It's 88, 87.92. That's what I was looking at.
I wish I didn't take any screenshots of when I bought the calls this morning at 525. I wish I would have. because and I did it for me. I'm not gonna, who'd you do it for? I did it for me. No, well, that doesn't sound very altruistic, Tim. No, I did it so I could also talk about it in a future show. Like I'm thinking of, like, it's like pool Danny when I'm doing these shows. Like Danny and I don't really talk before the show because I want authenticity from Danny and Don. So I try not to discuss what I'm doing. But Danny, I had planned to talk about all this next week. So like I'm shooting pool and I'm thinking, well, how do I want to shape the show this week and then the show next week? Well, hell, if I do, this was all going to happen today. That's just kind of, I don't know what the hell I'm going to talk about next week now, because I had this whole thing where I was going to go back today, take screenshots of what I did and explain all this implied volatility to people next week, while earnings season is just really starting.
And by the way, even though you're doing it a little bit more sophisticated, a little more complicated than we do for clients, you never take a position that's opposite or contrary to what we're doing for clients. We're bullish on Netflix. You're just doing it a different way that's a lot more complicated. Most,
a hell of a lot more aggressive.
Won't follow.
Yeah,
and so
a hell of a lot more aggressive. We've traded Netflix really well this year. We're actually in, what are we in, Danny, Netflix? I'm doing it from memory. I believe it's 425 is where we bought our latest position of when we established the latest big position of Netflix. Oh, Danny, you froze a little bit on me, but I think there you go.
I can tell you in a,
yeah, it's like 425.
Yeah, I can. Yeah, it is 28% gain. Yeah.
And so so I was going to have this whole talk, Danny, about how to know when to be aggressive, and now I've just kind of look at that, implied volatility go up. Anyway, no, never ever trade. I trade with the clients, which, by the way, is something I wanted to talk about next week too. I'm shooting the whole show in the foot right now. Do not let me not get to volatility futures for sell-off signals, okay? Kid, I'm going to go off on a tangent here. So hang on. So we trade at what's known at the block level. So when we say our entry price is 425, every client that's in the stock and ETF portfolio, or if Don bought it too for protection, if we combine the order, everybody gets the same price. It's a way when we trade on an institutional platform, and that institutional platform, whether it's at TD or whether it's at Schwab, or now IBKR, whether it's on either of those platforms, we trade at what's known as the institutional level or the block level. And so when we make a purchase, we're purchasing by percent. So let's say we do a 5% position in Netflix. Well, that 5% position in Netflix then gets bought, and then everybody gets the same average share price. It's such a big deal. And I'm talking about it, and I had planned to talk about it next week because nobody knows that. You all think, well, why would you know that? Some of you might think that, well, we go in there individually and we buy, and you're like, if you're the last person, you're going to get a jacked up price. And that's not the case at all. We buy as a group when we make a purchase, and then those purchases get netted, they get averaged out. Everybody gets the same average share price, no matter if you're a super duper large client or one of our smallest clients. Everybody gets treated the same. It's a really big deal. One, it's the law, okay? And two, we would have it no other way. And so, do you have anything you want to say about that, Danny? Because I think it's one of the most asked questions we get, and I have not addressed it in a long time on the show.
No, we whatever strategy you're in with everybody else, including
ours,
money. And so if, for instance, if you're at Schwab, my family has money in both the stock and ETF portfolio that Tim and I run, and Grotection that Don runs. Both, we have both strategies. You would get the exact same price, the exact same time. If you're over at TD, and for instance, you're in Grow, all of Don's money is in his Grotection strategy he runs, you get the exact same price. And by the way, when we do a trade, we've actually got two. Well, Don's got four, Tim's got a couple, at least two or three. I've got two at home. I've got three at work, but we'll have TD and Schwab next to each other on the different screens, and we'll hit submit. So when I say the exact same price, they may be a tenth of a penny off different from Schwab to TD, because they're
Yeah.
almost simultaneous. So the
But
whole
it's a
point
big
is
deal.
there is no front running, there's no cherry picking.
Nope. That's exactly it. And look, a lot of people don't realize that. That's how they had to write it into a law, because that's what unscrupulous people would do. They would cherry pick. that we would never do that anyway. And by the way, we'd be run out of town if we ever did that. And who wants to be run out of town? I don't. So anyway, Danny, this Netflix price is like a beacon that I cannot take my eyes off of right now. Look, stock nerds, I get just like you do. When I see big flashing numbers, especially when I'm involved in them, Danny knows, he's watched me be glued to a screen trading 1 minute charts before. And so I can't, I just can't, I need to take my eyes off of this chart right now. So let's do some sell signals. Danny, you know what, in all the excitement of Netflix, I forgot to talk about, I wanted to also talk about $10 stocks. Oh, look, Danny's sending me a text message here saying you froze. You're freezing on my end a little bit too. It's fine.
Yeah, just a little bit.
Yeah.
Your voice sounds perfect, but your
Yeah.
face will freeze for about 10 seconds, and then it's on. And I know what it is. You've got so many TD live
Yeah.
feeds sucking the lifeblood out of
I
your,
do.
and then you're trying to run the video. So
That is true. Let's do this real quick. Let me show you volatility futures.
yeah, I was about to say, let's do that before we forget.
Yeah, because with the volatility futures, this is how I'm going to tell you when I believe the sell-off is going to occur. Like we're on the cusp of a pretty big pullback, and I want to get out of the way for that. And regardless if it's Netflix, regardless if it's Tesla, regardless of whatever it is. So let me show you this. So when I'm looking at the VIX futures, if you're a thinker swimmer, you can get all this information too. So this contract has 12 days left, but I want to look at them in kind of sequential order for the next 3 months. So I'm going to put this contract out of my purview, and I'm going to just come down to where I see the next contract size. And so let me get that squared away. And so I'm looking at 21,000 of the August, that 40 days left, and I'm looking at the SEPs, 68 days left. And look, this is the way it should be, where the volatility futures, the month or the contract that has the shortest duration, which is July, of the three I'm looking at, is priced below the August. And the August has shorter duration than the September's, is priced below the August are priced below the September's. I don't know if I said that properly, but that's what I meant to say. So that makes sense. They're stacked like this. When you see, stock nerds, when you see this this contract pricing above the next month's contract, and then that contract pricing above the contract with the furthest duration that we're looking at, that's when you know that professional traders believe the market is about to sell off. And so what they're doing is they are buying protection. And it doesn't matter that
the price of short-term insurance, right?
Yeah, and they're buying a ton of protection. And even though that duration is smaller, they're saying, I don't care. I need something right here, right now. And that drives, it's called inverting the price, is what I simplified it. A lot of people like to talk very fancy around this topic. Don't let them do that to you. You want to be very clear and simplistic here. That price is inverted. And when you see the price invert, know that you're knocking on the door of a big price move to the downside. It doesn't have to happen. It's a market and anything can happen. But the last time that happened, I pointed it out the night before, and the next day you had that 18-point drop in the Dow. It's a big signal. 1,800 points. Oh yeah, 18-point drop in the Dow, Danny. No, 1,800 points. And so
little difference, 2 zeros.
Big difference. And so it's just a huge deal that you want to be aware of. And look, I get it. This market, I'm going to say the word feels extended, but it's, to me, I look at the risk here. The VIX futures keep going lower. I know I've got a little bit more time left in this market. Doesn't mean I don't want to I don't want to keep the volatility of the velocity of money going forward. It doesn't mean any of that. It just means that, am I going to clear the decks here in my portfolio? Probably not. Now, could I wake up Monday to a disaster? Let me give you a little secret here. You can wake up every day to a disaster. And the only way to control that is two ways. Don't be in the markets or use position sizing. So I flew helicopters in the Marine Corps for about 10 years, did 3 deployments to Iraq. And we started every flight brief when it's just you and your co-pilot, every flight brief with safety is paramount. Well, no shit, safety is paramount. But we actually physically had to say it before every brief. You just, safety, the words safety is paramount, safety is paramount. It started every brief. Before we start, safety is paramount. Do we have any risk factors? And you had a risk assessment sheet. Look, we all joked that if we really wanted to be safe, we probably would just keep the helicopters in the hangar.
Wouldn't go up.
We wouldn't go up. So there's always an inherent risk. And how do you mitigate those risks? When you get in the car, you buckle your seatbelt. You buy a car with airbags, and that mitigates your risk. You make sure the tires are properly inflated. You have enough oil in the engine, enough gas in the gas tank. You have brakes that you know will get you to stop. Like, you mitigate your risks. And mitigating your risks here means you understand when the market is showing you these signals. And I've got one right now with the put call ratio, but notice that I'm not using one piece of information in a vacuum. I'm looking for, are the indices breaking? Well, the weak indices are the Russell and the Dow. I've been short those for a while now. So they hedge me. Okay, if I wake up to a disaster, will it hurt with the long stocks? Probably. Will it be dampened by my bonds? By the way, Danny, bonds are a screaming buy here. No, that's not a recommendation. I just like bonds here a lot. Bonds. I've got gold.
For a
I've
trade,
got,
for a long-term buy and hold for bonds.
Yeah, there you go.
I want to clarify that.
Please do. And I've got 2 short positions. And so I think that's enough to help me cushion whatever downside if I should wake up to a disaster. And because my stocks are generally outperforming the indices, I'm able to make gains. But right now, like when I look at the VIX futures here, I don't see the things that get me to say, Danny, we need to start lightening up. And I come to this S&P chart here. I'm looking at the S&P futures on a daily basis. And my friends, this is such a bullish pattern. It's a super duper bullish pattern. And you want to recognize that. You want to take it down smaller time frames and go, what can propel this market higher? And like that daily chart's bullish. If you come up here and start taking out this area here from earlier in the month, or 7.6 or earlier in the month, then there's a really good chance you go up and challenge like 3,200. And so that's only 50 S&P points away. But you got to understand, the market is an equal opportunity dream destroyer. So if you're super bullish, know that the moment you feel just all the endorphins kicking in, all the good things you feel about how well you've been trading, you're probably going to get your butt handed to you. And then if you're super bearish, you know the pain. You're in a hurt locker unless you're short the right stocks, which is really difficult when they play the upgrade, downgrade game. Or people are just running certain things that you think should be going lower, but they just keep going higher. And so it gets to be a difficult road to hoe. And so I keep saying on the videos with you, I want to be long the strongest stocks and the strongest commodities, and I want to be short the weakest indices. And that has been my game plan pretty much since February, when we noticed the whole thing unwinding. And then by the end of March, just every week climbing. So when the markets were down 35%, the most we were down was what, 7%, Danny?
Yeah, seven, a little over 7 in the stock and ETF, and a little over 8 in the Grotection.
And now we're very well into the green.
Yeah,
it's a big, yep. And so, and Donna, I'm telling you, like when you look here, we haven't updated this chart. This is Don's Grotection. So this is the S&Ps are right here. This is the traditional advisor brotherhood. And then this is Don. This is an equity curve. This is an actual equity curve. And you can see how much less risk that we had compared to the traditional advisor brotherhood, who are financial terrorists. And
You can add another
and
7 on that. Yeah.
yeah, and then you can see here, this is stock and ETF, and this has continued to just go this way because this is the end of the month, and then we've just had a bang up beginning of the month here. And then so this is the tab, the traditional advisor brotherhood. And by the way, the tab, if you want to know where they live, Edward Jones, Raymond James, Merrill Lynch, Morgan Stanley, and a whole bunch of other places that you just might not want to be. And then here's the S and P's. And so, yeah, like it makes a tremendous difference. And so that's why I always invite you, like if you want these strategies done for you, we're absolutely more than, we'd love to be able to help you. But the other thing we do for our clients is we actually do webinars with them. So if you want to trade along with us, you absolutely positively can. A lot of our clients are active. Some of them want to retire. They don't want to be glued to the screens like we seem to be. But
or their wife wants them to retire.
So yeah, and so husband, yeah, and so you just it makes a difference avoiding the sell-offs and understanding
by the
how.
Way, I would like to jump in on a couple of those indicators you were talking about. So the put call ratio is called a contrary indicator because when people get too bullish, when everybody's bullish, everybody. So when the put call ratio gets real high, so it's down, whereas at 0.9 or even 0.8 or way below 1, that means everybody that was bullish has already bought in, and it only takes one seller to turn the market the other way. Conversely, when the market gets the put call gets real high, more people are buying insurance, buying puts, and so it usually works opposite because it's counterintuitive. Now the VIX futures, the stacking of the VIX, is a concurrent indicator. It's actually what is happening right now, immediately, right here. It's not a lagging indicator. It's not a forward-looking indicator. It's right here, right now. And those are what the professionals use to hedge. And so what he was talking about is if they're inverted, that means 1 month's worth of insurance is much more expensive than 2 month or 3 month. So think about it. If you're buying homeowners insurance, and it's more expensive to insure your house for just 1 month versus 3 months, a whole quarter, something's not right there. They think a forest fire is coming through and it's going to burn your house down. It's fire season, whatever it is, the risk is much higher. So Tim did say that not every time the VIX inverts that you'll have a market correction or even bear market. However, every time you have a correction or bear market, the VIX is inverted.
That's exactly right. And that's
why maybe 4 out of 5. So we're going to get defensive every time the VIX inverts because it just takes that 1 out of 4 times that it goes down 25, 30%, like in March, that it makes up for the time you may have got out a little early and then you can just get back in. Tim always says you're only one trade away from getting back in.
Yeah. And that's what I've been trying to demonstrate to people this year through these video podcasts since the pandemic hit, that you just got to keep the velocity of money moving forward. And so like when I look at these S&P charts with you stock nerds and market lovers, like that's a 4-hour chart, but let's get it back to a daily. Like that's a beautiful chart. If I look at our average true range charts, which we've been covering in depth with you forever. And so like here's the mean, here's 1, 2, and 3 average true ranges. And what does that average true range represent? It's this, over 21 days. What is the average movement of the S&P futures? Well, it's 80 points. And when someone says, are you extended? Like someone's going to say, I feel like the market's extended. I will tell you that this 3 ATR move coincides with the market about to what? Plummet. We are nowhere near 3 ATR. Someone could say, well, Tim, that's because we're weak. Maybe the market's weak, or it's just consolidating for the next move higher. I don't know. I just want to know where we are in time and space. We're not extended on the S&Ps. Now, what about the NASDAQ? So you look at the NASDAQ and we're getting there. And so we're getting close. We're 2 ATRs above and we're reaching for that third. The last time we wicked up and hit that third, major sell-off. It's rare that you get to a third, but look, you can ride that third ATR, but eventually, look, you just give it all back. you get in the zone of the third ATR and you give it all back. You just want to be cognizant. It doesn't always have to play out this way. So
Is
when
that a
people
weekly or daily? I'm sorry.
daily chart. And so you don't always
Still
get with
bullish,
it.
but a little extended, but still is a bullish chart, but it's extended.
Exactly. Exactly. So you just want to be really careful about throwing around extended. I have met so many traders. So when I worked for Investors Business Daily and Mr. Neal, I would go on the road. I'd meet like 40, 50,000 people a year. And the majority could never tell me a couple things. Well, what does extended mean to you? Can you define it? And these ATR charts are a way to define it. Or you can use a 21 exponential moving average on a normal chart and you can define it. It's X percentage above. And then you have rules that surround that. That's one way. And so the other thing that I used to hear is people just buy stocks, and I would say, what's your favorite setup? You have to know your setup. And so this is knowing your setup. Like if I got a setup here that we hit the third ATR, I'm probably going to sell some NASDAQ stocks that I own, and I might even get short via PSQ, the NASDAQ. And so that's
and conversely, when it pulls back, as long as the indices aren't breaking down, as long as it pulls back to the mean or even below that, that would be a buy signal, even at the second or third ATR on the downside.
And that's how we buy stocks. And so let's keep that probabilistic mindset going. Danny, I don't even know if we're going to get to the stock nerds. I created I'm creating a whole different segment of the show called Stocks Under $10. Some of you love them, and I don't mind them. I traded one this week just for you, and I wanted to show you the setup. I just don't even know if we're going to get to it, Danny. I'm talking about stuff I had no intention of talking to, but that's the beauty of the show. Like I can go where the music's taking.
Freeform, baby, freeform.
Well, like how I had every intention of talking about deflation, but once I talk about deflation, I got to look. Danny, let me show you Netflix. You ready to see Netflix?
Yeah, let's see Netflix.
550.
Yep.
It's insane.
Well, let's go over a few stocks in the moves that we did in the portfolio today, and then this week, and then you can talk about how to handle stocks under $10.
Okay, let's do that. What do I want to do? Let's start with the one I sold for a loss, because I think, and I started out the video the other night. I always want to start out with my losses when I do a video with you stock nerds. Now you're like, let's start out with a loss here. No, I had other shiny, bright, flashing things I wanted to talk about, and I've already covered this. This is in the past. This is on 7/7, and today, as I'm taping this, it's 7/10. It's a lifetime ago. And so let's talk about Boeing
and Netflix.
All right, yeah. So let's look at Boeing. Boeing is up 2.5% today, but I sold it. Let's get it on this chart over here, this chart set. Give me a second, Danny. My charts they're not helping me. Here we go. So let's get this on a daily chart. So I sold Boeing on 7/7. There's 7/8, 7/7 right here. And we bought it last week, and Don and I were talking about it's this flat area, it's holding. And then nothing happened with it. Like we actually, it really didn't go anywhere. It was holding support to 21, and then it broke down. And we talked about taking the trade in the last week's video podcast. And then you got a close here below the 21, a close here below the 21. And on this day right here, a really astute stockner goes, hey, are you going to sell that? It closed below the 21. And I said, well, that's not really quite the rule. Even if we got two closes below the 21, is my risk been met? Or is it clear that this thing probably wants to head a little bit lower? And so that last part's a little up to interpretation. But I did not want to do that. But when I'm looking here, I sold it pretty much where it's at right now. And we ended up taking, I got to look at my notes, I sold it for a 5.7% loss. And here's the thing, I can do so much more with that money. Like I'll go over the stocks I bought with that money, than I can wishing, hoping, and praying that Boeing goes higher, because I just don't know. And look, you can tell me travel's dead, people are canceling airplane orders. it came out today that I forget which airline it is, canceled a bunch of airplane orders and the stock's up 2.5%. You just, it's really hard to trade the news. And so I tell people to turn off the news. Like you can watch the news, but it's really hard to turn off your ears, and it's really hard to turn off your ability to wrestle with all the people that are unemployed. God bless. And I mean that. That's not me.
I'll go you one better. A lot of
Yeah.
these massive hedge funds and people on the quote inside, they have boots on ground, and they know these stories that are going to come out. So, you know, we always say here in the shop, it's first price, then news.
That's it.
So
Yep.
it's on the
First
chart.
price, then news.
So the sell-off could have been because of that order thing, and now you're getting a relief rally. It's like, oh, okay, now it's out. Now I can.
Well, the price
get
is the
back in.
news. And
Yeah,
so what happens is
exactly.
whether it's Twitter or you're watching something on CNBC, Bloomberg, or Yahoo Finance, because price happened, they have to shape an event around it.
Right.
And so that's where first price then news comes from. And so you want to take your cues from price, not news. And so I know that to somebody that might sound like a game of semantics, but it truly isn't. So I saw Boeing, I took the loss. Well, what did I end up buying with Boeing? And then Danny, we'll do our sells here in a moment. I ended up buying MTH. Oh, I didn't type. Meritage, MTH, which is Meritage Homes. And look at this beautiful chart. And so I bought it here. And then you can see the next day it goes up 6%. The next day it comes down 6%. And now it's up 2%. This is a beautiful looking chart for me. Now, would I have liked it to kept on going? Yes. But I took a 2.5% position. So Boeing was a 2.5% position, folks. That was my total risk in Boeing. Took a 5% loss on 2.5%. So now I've got Meritage at 2.5%, and I've got DR Horton. No, I don't. DHI. Danny, I did it again. Here's the running joke in the shop. Every time I want to type in DR Horton, I type in Darden Restaurants, and I do it every time. So here's DR Horton, and I bought DR Horton same day, same time frame, right here from this flat area, and you can see DR Horton has had a nice little advance too. So when I don't know which stock to buy, what I typically do is I buy 2.5% each to give me a 5% position.
100%, yeah.
Yep. And so now, what is the last time I did that? I did
That's
that
actually
with
a nice looking chart too, right there.
Beautiful chart, CHGG. I did that with Chegg, which has hit my 1272 extension. Okay, it's up another 2%, and I've got about a 16% gain on this. And then I sold this the other week. What I'm about to show you, DocuSign. I sold DocuSign earlier. Like last week, and that was a tremendous gain. That was another 16%. So I took, excuse me, one second.
We've traded that probably two or three times this year.
Yeah, if not more.
Yeah.
So 2.5% in Docu was good for 16%, and now 2.5% in Chegg is good for 16%. So I'm going to have Danny sell Chegg here momentarily. Well, why sell Chegg? Why sell Chegg? So if I type in CHGG. Look, not only did I hit a Fibonacci extension, which by the way, it's just a line on the chart. It doesn't mean I can't go higher. I'm in the zone of this 3 HER. And I know from studying this chart that when you get, what did I just do in there? I know that when I get in the zone, when it's not earnings related of that 3 HER, it wants to pull back. And so there's that 3 HER. Look, earnings are not till the beginning of August. So if Chegg pulls back, guess who's probably going to be in the front of the line to buy Chegg again? This guy. And so, Danny, would you sell Chegg, please? We'll just wrap it up now.
Sure.
So what that does is now I've taken 16% out of each stock that I bought 2.5% out of, which is a hell of a lot better than sitting, hoping, wishing, and waiting for Boeing to make a gain, right? So now hopefully the two stocks I bought with Boeing are the Meritage and the DR Horton, hopefully they act well. And so, and do the same thing for me that, oh, Jesus, Danny, can I show you something?
Yeah, done.
Look at Netflix. Look at Netflix, and I 553, Danny.
Look at the implied volatility now.
Oh, let's do that.
I guarantee it's gonna be 90. Yeah.
No, it hasn't actually moved up.
Wow, that's strange.
That is strange.
So it'll run.
Yep.
It'll catch up.
So before someone calls me a hypocrite, I want to address this because someone's going to say, well, Tim, here's the third ATR and Netflix didn't pull back. I get you. It's probabilities. And so Netflix has what? A binary event coming up that people are betting heavy on. Look, this is the market savvy that you just develop. Look, I make enough mistakes, and I talk about my mistakes constantly with you because that's reality. But on the flip side, when you see your setup or you've seen something a number of times, when do you let it run? And so look in the left-hand side of this chart. Here is Netflix running up before earnings. The last time it reported earnings, third ATR and pulled back. This is a different story, and I've been letting my position in Netflix run. And so to the point where I got even more aggro or more aggressive this morning and loaded up on a bunch of calls when it was up at 525 and not thinking that it was going to 555 today. It's rare that this happens right on the show, Danny. Like, it's why I'm talking about it, because it's so easy after the fact and go back. But anyway, Netflix, what a crazy, crazy move. Okay, so that's Netflix. So, let's look at let's keep the velocity money going forward. Let's talk about gold. Danny, I do want to talk about this. So GC, the commodity, is not extended. GLDM, which is, I look at GLDM though. Danny, can you look at this real quick? I know you're selling Chegg, but I want to show you this. So let me show you gold. And so I take when I'm buying commodities, stock nerds and market lovers, I take my signal from the commodity itself. So here's GC, and GC is, here's the mean, is not extended. There's the third ATR, there's the second.
One ATR, yeah, a little above.
Yeah, it's only one ATR above. But when you look at what I own for the clients, GLDM, it is up at the third ATR, but that doesn't mean I'm selling my gold. I take my Q.
You got to go off the futures contract or the spot price itself, not necessarily the ETF.
That is 100% it.
And that's especially true when you're doing leveraged or inverse leveraged ETFs. You don't want to use that. That chart will make you neurotic. You need to go off the S&P futures or at least the single, SPY or S&P index itself.
1000%. And so now what I want to do is show you this, Daniel. Let's look at GDX together. So I've been talking about this, and I'm not 100% sold or sure that I'm going to sell my GDX. It's only down 1% today, but third ATR, but there's the pullback. Now, do I think it pulls back more? I don't know. What I want to do is, to make me want to keep this, I want to see it start to flag out. Like, here is a flat base on a 195-minute chart starting to form. That's my setup. And you can see all the little consolidations that have stair-stepped this entire move up. And so I want to see it hold here, but Danny can load it up and sell it during the show. I'm not going to sell it right here, but it's on my mind to sell it because it's near this third ATR. And then CNDS is Cadence, CNDS.
CNDS, you got to get her.
Did I do it again? Thank you. Here's Cadence.
CDNS. I always get the N and the D. I flip them. Yeah.
Yeah, it's that left-handed dyslexia thing that I've got going on.
So no, I do the same thing, and I'm not dyslexic or left-handed.
Then it's just me. Here's Cadence, and look, Cadence is getting into that zone of the third ATR. I'm not 100% sold. Like, things can flag out. And I want to point out the subtle differences. So if you look on the left-hand side of your chart, over here, right before earnings in Cadence, comes up to the third ATR and then pulls back. Just because it gets there doesn't mean it has to pull back, but there's a really good chance third ATR pulls back. So I'm now consolidating along that third ATR, but and I love consolidations because they're continuation patterns. It's a really big deal that you understand that. I talk about consolidations all the time because look, a lot of people love cup with handle patterns, and we're not just technical traders here. Our process is actually 70% fundamental, 30% technical. We buy the top 5 to 10% fundamentally and technically of the market combined. We're one of the few shops in the free world in China to actually do this and practice this and talk about it. And so there's about 7 common traits that all winning stocks have They coalesce right before, they all come together right before the stocks make their biggest price moves. And so when you see a cup with handle and those 7 common traits, those are powerful moves. I like what happens after the cup with handle forms. And so the cup with handle happens, it typically goes up 15 to 20%. Then a sideways pattern develops, and those are typically continuation patterns to the upside. That's your opportunity to get into a stock that's proven that it can win. And what happens is people like cup with handle. But what happens is then the handle dips down a little too far and that stock's not a winner. I want to increase my odds exponentially of only buying the winners. So I wait. I wait for the initial move and then I buy. Is that ass backwards for some things? Yeah. I would rather get a stage 2 stock than a stage 1 because I know the success rate of the stage 2. If the story of the stock is still intact and the market's still intact, I have a better win ratio. And so, someone will say, well, win ratio doesn't matter. It's nipping your losses. Well, I have a better win ratio. I nip my losses and I let my winners run. I'm okay. Does that make sense, Daniel?
Well, yeah. So what Tim is saying is the reason he likes a stage 2 versus a stage 1 is stage 1, it's still indeterminate whether that's going to be a leading stock and whether that's going to hold and it's going to go. Once it's proven itself through stage 1, now you know it's a leading stock. So stage 2, if it starts breaking out again and starts going higher, that means you really may have your hands on a winner that could go through stage 2 and even stage 3. So stage 1 is early on, and out of your stage 1 stocks, not all of them are going to work out. Stage 2, even though it feels extended, you've already culled the herd, and now you've already gotten rid of the ones that didn't quite make it. Now you're looking at the best of the best.
That is exactly it.
Damn, I'm good.
All right. Yeah. So let's do this. I'm sorry. I'm looking off screen at Tesla. I'm not. Well, Tesla. I wanted Tesla.
By the way, did you like my culling the herd analogy?
You like that.
Make fun of me with my horns on my Cadillac because I'm from Texas, so I thought I'd throw that in there for you.
Danny, I'll show you one that I missed. I've got a little bit of FOMO with it. And I like to talk about this when it happens to me because I called Danny last night, like 10 minutes before the close. And I said, Danny, I want to get some Tesla. No, it was like 20 minutes before the close. Then the market got soft. I'm like, screw it. I texted him back and I said, no, we're done. We're done for the day.
Well, we also had to wait for some cash to settle because it would have been kind of tough, but we were threading the needle because we were almost out of cash.
So. Oh yeah, because so I bought thank you, Danny. I totally forgot what I bought yesterday. I bought Walmart. Was Walmart yesterday?
Walmart was yesterday.
Yeah, it was yesterday. So Walmart we bought on Thursday, so WMT. So someone's going to say, Tim, what the hell? You bought Walmart at this third ATR? Yeah, I did. And so I just kept taking it down to 100. These are bullish patterns. When you see a
bull flag right there.
Yeah, when you see a bull flag form, look, they're continuation patterns. And so I bought. Now look, would I rather have a 6% gain in Tesla than a 1.5% gain in Walmart? Yeah, I absolutely would. But I ended up with Walmart, not Tesla. I had bought Walmart earlier in the day, but then I noticed, I'm like, and I've been hawking Tesla because I want to get back in. And gosh darn it, Daniel.
We just sold it about 10 days. We just sold it recently and we had nice.
Yeah, we wrapped up 48% in it. And so I called Danny and I'm like, maybe we need a bigger pullback. So, because I don't want to take just 10% out of it. I would like to take another 40 or 50% out of it if possible. I just don't know if it's going to give me that opportunity to pull back. But that's real-time FOMO for you folks. Do I wish I had Tesla? You're damn straight I do. And so did I miss it yet?
So that's why it comes down to following the rule. Here's the hardest thing. So following the rules, but a lot of people that break the rules will go, they'll start getting a loss and they'll go, it'll come back, or I'll just wait till it breaks even. If you ever hear any advisor say, well, it's not a loss until you sell it, you need to run. It's a loss the day that it went down, not the day. You know the difference between a realized loss and an unrealized loss? A realized loss when your wife finds out about it. Yeah. Look, it went down. The day it went down, it went down. But here's on the flip side. So you got to cut your losses and move on. Even if that stock, as soon as you sell it, like the other stock the other day you were talking about, that as soon as we sold it started rallying.
Oh, Facebook.
Yeah, Facebook. You got to let that go and just move on. Now, on the other side, you're looking at stocks and you pick one and then the other one runs, or if you sell one to book some profits and then it keeps going up like Tesla, You got to learn to let that get. That's just the law of large numbers. If that's going to happen, you've got to accept in advance that that is going to happen.
Exactly.
It's like when I played competitive tennis, you got to have, you know, before you even go out there, sometimes you're going to win and sometimes you're going to lose. You just have to have a plan, and you have to go out there and you got to play to win, not play to lose, but you got to not beat yourself. And so here you just got to accept it in advance that sometimes you're going to be wrong. And by the way, sometimes when you buy a stock and it doesn't work out right, and you cut your losses small, that doesn't mean you were wrong. It means the market changed or something happened and things change. And so you had to adjust for that and follow your plan. If that same setup happened again, you'd buy that same setup again.
That's
You
true.
can't let that, you can't let that prejudice get in your way. Like, ooh, I got burned that time, I'm not going to do that again. Well, no, if the setup was right, it was valid, it's still a good setup.
Now, I am bullish bonds, folks, and I want to get into that. So I think the bond market here is telling you that this is a big deal what's happening. Let me set up bonds, Danny, and then the very last thing we'll do is do the $10 stock introduction, okay?
Okay.
So, hey, in the notes for the show, let's tout the $10 stock edition.
I was writing that down right as you spoke.
TLT is it? I think the bonds are telling you something here, stock nerds. Now, can bonds go higher with stock prices? They can, but it's what's happening. So TLT is going up in price, and I've had a TLT position, and we add it when new clients come in, not right away. I wait for lower prices. I wait for consolidation, all the strategic buying that we do. So when you come on board, stock nerds, like if you become a client of the firm, we don't just willy-nilly buy you into positions. We have to homogenize you in, and we get you the most advantageous. And just because we own it doesn't mean you're going to get it, because if it's extended, there's no way I'm going to transfer that risk to you. You came to us to reduce your.
We may be on profit watch. We may be about to sell it. Yeah.
You come to us for a couple of reasons: to minimize your risks and maximize your gains, not the other way around. And so that's a really big distinction. When you go to Morgan Stanley, Dean Witter, Bank of America, Edward Jones, the pirate ship down in Tampa, they're there to just take your money and run. Like Steve Miller Band.
There you go.
They're gonna Steve Miller Band your ass is what they're gonna do. That pirate ship, Raymond James down in Tampa, all they're designed to do is take the money and run. Okay, so here's the reason why I think you should be concerned. This chart of the TNX. So this is the 10-year Treasury yield. When the yields were coming down, like look at where the yield is right now. And I know someone's gonna say it doesn't matter. Over here is, let me minimize this chart a little bit more, Daniel. So when yields started to break, okay.
And Patriot Power Generator. And when
sorry, I was trying to take the money and run on there and then play it on the thing, but it had a commercial.
Matrix Power Generator.
Never mind.
There you go. So when you see the yields coming down like this, that's when the sell-off occurred. And then you saw yields go up. This is the bottom, okay? And now look at, this was another big move in the market. Yields come up, but the NASDAQ's at a high, and all you've seen is these yields drift lower. And there's a part of me that thinks if these drift a little bit lower, start taking out this zone and come down here, I think the market's in trouble. And so there's a couple of thoughts about this whole thing with yields.
There you go.
Go ahead. I'll let you do it. Go ahead.
Sorry, I like that.
Oh, no, I'm with you. So if the yields keep coming down like this, it's going to matter. Like today, it doesn't matter. Like today, when I'm speaking to you right now, it doesn't matter. It could matter on Monday. And there's a lot of things like a PMI number came out this morning, and it's deflationary.
Yeah.
And you're not, and here's the thing, you're not getting any yield. This TNX is the 10-year. Like anyone who's tried to get bonds that are not junk, that don't carry an exorbitant amount of risk, you're not getting paid for anything. And so where else are you going to go?
What was it? What was the yield you got on that 10-year? What was the yield?
The yield right now, when Danny and I looked at it this morning on our 7:30 phone call, Dan and I talk every morning for whatever doesn't matter the timeline, it just matters that we talk. And I said, this 10-year is concerning. It was negative, and it was 5.6 this morning. Well, I can tell you what the low was. It was at the low. Here, hold on a second. The low this morning was 5.73. So I was close. Yeah, 5.73. That's a big deal. Like, it matters. Like, but the thought is that there's nowhere else to go to get yield. Like, if you're older and you're trying to outpace the price of the inflationary costs, I just said deflationary, but food's not cheaper. Your cars aren't getting cheaper. The things you need to live, energy. You might, well, gasoline's cheaper, Tim. Have you got an electric bill lately? Electric's not cheaper. And so, and if you want to take it a step further, all the people that aren't using the roadways right now, so there's no tolls being paid. You're pumping less gas. There's not the gas taxes being paid. Things are going to go up. States are going to start charging you more for things. You're not going to beat inflation, and you're sure as hell not going to beat inflation with the yields given right now. And so what does that do? That chases people to stocks. With Revere Asset, that's not a bad thing because we have rules for entry and rules for exit. But if you're buy and hold, if you're at any shop, LPLA, Edward Jones, Morgan Stanley, Bank of America, Raymond James, and it's a buy and hold mutual fund portfolio or just buy and hold, you have a really good chance of getting hosed. It's a really big deal right now. And it doesn't matter if they mix you in a 60-40 portfolio. Look at this. Let's go back to this chart. Look at the outperformance. This is 60-40. That's what this line represents. 60% stocks, 40% bonds. And look at, this is my stock and ETF portfolio at the end of June. Look at the difference in equity curves. Now multiply that over how many years you are investing.
As of last night's close, the 60-40 index and the index we use in the S&P 500 were both down about 2.5%. They're almost identical.
Oh, these two are down 2.5%?
As of last night's close, the S&P and the 60-40 index. Yeah. I mean, right, within a 20 basis points of each other, 0.2%. And by the way, you were talking about the 10-year yield. So the 10-year yield, the interest rate on it is like 0.6.
That's what the chart is.
Yeah, 0.69. Oops, sorry. Think about that. A little over 0.5% for 10 years of risk.
Oh, I keep bringing
a 30-year is around 1.5. Think about that. Think about that.
And so you're getting chased to stocks, and I can't begin to tell you how blessed Danny and I and Don are to be having a good year. But the chart, the line that you want to focus in on isn't the result right now. It's this. When the market is selling off dramatically, where's your risk? How much better off are you? And if you and the 10-year yield is chasing you into equities because you need to be able to outpace inflation. But what happens is people get buy and hold mutual fund portfolios or just buy and hold nonsense. And that not only can they not outpace inflation, their drawdowns match the indices. It's awful. It's absolutely awful. It's the worst of the worst. And so I don't feel chased into stocks. I feel like we have less risk because of our sell rules that we talk about every week. And so look, if you've got loved ones that don't quite I think the stock nerds and market lovers, they all understand this, but it's we know you pass along our information. We're grateful. But if you're new to us and you've never seen people talking to you in this kind of transparent, real way, just call us, please. I don't got nothing to sell you. Danny has nothing to sell you. We don't sell insurance products. We don't sell annuities. We don't sell lifestyle planning. We do planning free for our clients. We do everything we can to the benefit of the
planning strategy, not products.
Yeah.
Anyway. And it's investment strategy. You're paying us for our brains, not for
Let's do this. So I want to do stocks under $10. I'm not going to introduce everything that we're doing, but I want to let you know that you're going to see this coming from us. And we get the question we get asked a lot is people want to know, can we can we text them alerts to when we're doing things? And the simple matter is that you actually get alerted through your email. Every time we make a buy or a sell, the moment we allocate the trade, you get an alert. That's how people like to follow along with us, so they know what's going on. Then they watch the videos at night. We do 6 videos a week. Every night, Don or I come on and we do a video outlining what we've been doing, where we see the market heading, because anybody can talk about the left-hand side of the chart. I need to focus on the right-hand side. I need to focus on the risk. And so we're always constantly talking about the risk. But it don't, like, I cut my teeth back in the 90s with penny stocks, and I loved them. And so that's clearly stocks under $10. But then I was talking with a stock nerd this week, and he's a great dude. And he was talking to me about, oh, I'm not typing. He was talking, I mean, this guy is in the know. He was talking to me about Blink. And I'm like, Blink? What the hell's Blink? BLNK. And I didn't know what Blink was. So, and we're doing this over Twitter. And this is a dude I have a ton of respect for. And that doesn't mean that I just have a ton of respect for the person I was talking to, because he's really in the know. And so I'm like, Blink, sub $10 stock. And I'm thinking, you know, if he's interested in Blink, how much of our population is really super duper interested in stocks under $10? And so let me see if I can start putting together my rule set and transfer that to stocks under $10. And so I bought, let me just show you this, Danny. So right before the close on the 7th, I started buying Zynga, the game maker. I think they did Farmville. I don't know what they do. But so what I did was I applied my screening process for stocks that we normally find, like Cadence or Docu, or the whole screening process. And like, let me just transfer all of that to stocks under $10. Let me find the ones that are outperforming the S&P 500, and then let me just buy one based on my rules and my time frame. And so I didn't want to buy something extended. I wanted to keep it in line with everything that we talked about. So then I ended up buying 800 shares of Zynga right before. And you can see I was just pinging the bid, $100 lots, 8 times. And so this is July 7th. And I ended up selling it July 8th. And I could have gotten a better exit. So I don't need to show you a picture. I can just show you on a real chart here. So here's Zynga. No, that's Blink. Let me get Zynga, ZNGA. So here is July the 7th. I'm going to put an arrow right here. So if you were saying, Tim, this met, by the way, my criteria pretty much for a stock I would normally buy for the portfolios, but it's under $10. And what I want to do is avoid $10 stocks that can be manipulated. And so we'll start unveiling these rules next week with you. I want to do it when Don's here, but started forming up some rules. And this is my jam. This is my setup. You can say, well, that goes a little bit longer. It does, but it's really focused in the last few days here. And then it gaps higher the next day. And so that's the daily setup, but I start taking it down to like a 195-minute chart. And so here's July the 7th. Here's Wednesday. Excuse me, here's Wednesday. Let me just get that for you. You get 2 bars on a 195-minute chart. These are the 2 bars that are Wednesday. The second bar started clearing. So there's my little flat base. I'm always talking about these 195-minute 4-hour charts. There's the gap. And then I took it down a little bit more to a 30-minute chart. And so here is, here's Tuesday into Wednesday. And volume, I'm watching volume. Volume is coming into this towards the end of the day. That's what led me to it as well. So volume's coming into this. So I bought 800 shares right before the close, and then you get the gap up. And now here's what I ended up doing. I sold it too soon, Danny. So I sold it way too soon. The market got soft, and I sold. So I bought it at it doesn't. Oh yeah. So I bought it at this is an average price of about $9. It's about $9.88. We'll just call it $9.88 or $9.89, and I sold it above $10.17. And so I sold it too soon. I sold it on a 5-minute chart. So the next day I'm like, oh, it gapped higher. Let me take a look at this. So let me just get this a little bit minimized. So now I'm just clearly gonna manage this trade on the gap up. No options, straight stock. Gonna manage this trade based on my rules. So here is the gap higher, and when it starts crossing, here's the 5-8. It starts crossing below this 1020 level. I'm like, let me sell it, and I get out at 1017. And so, was a little bit early, I'd say so, but that was good for about 2.9%. Those $10 trades, could I have held it longer? I could have. I just wanted to sell it, and I wanted to make a quick profit, not very big profit at all, by the way. I just move on, but you'll see more of that from us. And Danny and I need to talk with Don how we'll disseminate these. Do we give people a watch list of $10 stocks on a Friday in the videos? It's just something to think about. We haven't really hashed out all the rules, but you're going to see us give you more stocks that are under $10 that meet our criteria, and we're going to set up some rules around them. So it's just a different way to approach the market.
And you listen, folks, under $10 stocks, you have to have rules, because there are certain stocks that are absolute, pure, unadulterated gambling. And look at that Zynga, that stock that Tim's talking about right there. That went from what is that, 9.7, 9.8, all the way up to 10.39. That only sounds like 40, 50, 60 cents, but on a $10 stock, that's a big percentage. And that's 2 days. That's Wednesday and Thursday. That's 2 days. And so these stocks, the lower the price of stocks, the more magnified the moves, and especially the lower the volume, the more magnified the move and more manipulation. So you definitely have to.
So it's not a
go in there with your eyes open. Yeah.
Not a departure from what we're doing. Just that there's so many of you that we know want to trade lower price stocks. And I tell people, look, go to fractional shares. I think fractional shares are, if you want, because you're afraid to buy Amazon or a Tesla, because you don't have, maybe you don't have the scratch, or you don't want the risk, or you're buying it for a custodial account and you're looking to maximize your portfolio. I'd go to fractional shares in a Chipotle, in some of these higher price stocks. But we know the attraction's there. So you can take our rules, and we can give you a couple more rules, and we can absolutely help you. We can make what we're doing here even more inclusive and even more engaging, and try to remove the gambler aspect of it. Because what's happening is, if you go, Danny, I don't know how much you follow what's happening with, I don't want to single out Robinhood, because it's happening across all the platforms.
No, there's tons of them.
But there's a lot of manipulation going on. And so there's a thing called Robin Track where you can see the most popular stocks. And so what happens is it's musical chairs. Like Ford's the most popular stock on Robin Track. And so this is a big move for Ford, up 3% today. And it's a $6 stock, and it's
and by the way, Ford is now under $10 stock.
Yeah. It's been that way for a while. And so, can you take our rules with stocks that have volume, that have that have fundamentals, that are outperforming the S&Ps, and time your entry to them? And that's all we wanted to bring to you, because we know you have kids that are interested in this. Believe me, the younger set is welcome. Like you don't hear Danny and I trashing anybody that's getting into investing or trading. We want you here. We need people in the market, and you need both sides of the market. You need bulls and you need bears. When everybody's on that put call ratio chart that I show you, that's all everybody on one side of the market.
Yeah, that just tells you whether the ship is lopsided or not. Is it port or stern?
Yeah.
Which way are we gonna flip?
Yeah, and so you need both to make a market. You need both sides, and so you welcome. But if you have an attraction to stocks under $10, which is fine, well, maybe we can absolutely help you. And so that doesn't mean I'm not saying we're trading them, but we can absolutely do some things with you to help you formulate a plan, get your own rules, maybe develop a screening process. And I think that's what we do as the champion of it. We are so the champion of the individual investor. We're not money rustlers. We're not salespeople. We're strategists. And so how can we help you do some of these things? Because what's going to happen is, it's musical chairs with a lot of these stocks, and it's easy to single out the Hertzes of the world. And when you see stocks like NEO running up, like, it's easy to get the FOMO, and it's easy to put all your eggs in that one basket and go, if I just had Hertz when it made a $5 move, or Plug Power that made a $6 move. I could have taken $100,000 and made it $600,000, but you can't be the person holding the bag when the music stops. And when somebody in this listening audience, it might not be you, but somebody in this listening audience has been the recipient of the bag when the music stopped. They didn't find a chair, they got a bag. And when you hold the bag, you get hosed. And it happens every day. And so all we're trying to do is show you a process that can be fact-based, unemotional, and absolutely apply some rules, and keep reiterating that we're not trying to make all the money. We just want to make the filet mignon of the move, sell it, keep the velocity going forward, minimize the losses when they happen, and they do happen. You cannot not take losses. Take your losses, take your losses, take your losses. And then you'll find a lot more balance, a calmer approach. And that calmer approach is so gratifying. What you got to say about that, Danny?
I thought that was very good. I was actually writing that down. Find your balance, take losses. I like that.
Yeah, like you have to be able to find your balance. And look, let's look at Chegg. Have I left some money on the table on Chegg? I don't know. Maybe. But you know what? That money can then be turned into something else. Well, Tim, how do you know it's going to be turned into something else? I don't. And nobody does. It's a market and anything can happen. And so you're taking all of our work in its entirety, and that's how you approach it. It's never one piece of information in a vacuum. Danny, let's do this.
Yeah, but and then, by the way, when you make 15% literally in less than a week, that's usually the easy part of the move. I mean, it doesn't happen like that. That's not the norm. I'm not saying you make 15% a week. I said when it happens, you got to take, like Steve Miller, you got to take the money and run and move on, because the easy part of the move, the big money, the fast money has been made. Now it's probably gonna be slower. So now you just need to keep moving.
So let's do this. Danny, do the normal outro of the show. And then I've got one last thing for stock nerds and market lovers.
Folks, if you like what you heard, please tell a friend, tell a neighbor. Just tell them to go to revereasset.com. They can sign up for our daily market newsletter. They just got to hit the subscribe button, and we'll send them not only this podcast on the weekend, but our daily market insight, a short 10-minute video every night. Tim and Don normally. And now Tom, I'm now got to go find a Tom.
Go find a Tom.
Tim and Don alternate that. And then also there's a webinar sign up. That's a separate sign up. That's for Don's Lunch and Learn, and that happens once a month. He actually does a live market webinar at noon Eastern, and you sign up for that. And even if you can't attend because you're working, he'll send you the recorded podcast later. You can always email questions, Dan@revereasset.com, Don at Revere Asset, and Tim at Revere Asset. My Twitter handle is @1 Danny Stewart. Tim is @TJ Riazor, and Don is D Vandenbord with a D. And you can always call us old school at 855 Real Wealth.
So I do like something in the next week, and I'm going to see how it reacts here, but I like Ring, even though it's down almost 4% today. Look, this stock comes up, hits just about 300 today, and then it sells off. If this, I'm going to butcher the chart. Well, that's not so bad. Let me see if I can minimize that. So if this comes down to the 21, that's actually its point. That's a great point of entry. And that doesn't mean it's going to work. Now, I'm already in Ring, but what I'm looking for is, can it hold the 21, which it's pretty much been doing this move. And so I want to see it come down to the 21. And if I take you to an average true range chart, and let me just minimize this. I want to show you why I like buying at the mean. This is the mean right here. That's 1 ATR, 2 and 3 ATRs, and that's -1, -2, and -3 to the downside. And so the average true range of Ring today, over the last 21 days, is just about $14.70. And you can see today's move is $11.75. Is this an outsized move from Ring? Well, for Ring, well, not really. It's 4% doesn't feel good to the downside, but it's not an outsized move based on the last 21 days. So am I really concerned? Not really. But if you want to wait for a leading fundamental stock to correct back normally to the 21, this is that zone right in here. And if it starts taking out these lows, maybe that's where you would sell it. You know, you would have some rules in place to help you get out of it. Maybe it's a 5% loss for you, you know, like it was for me in Boeing, where I didn't want it anymore. But Ring is just kind of correcting back to the mean here. It doesn't mean it's bearish, but if it starts going this direction, well then that's another story. But I'm interested to see how Ring does. I like Ring. And if we, you know, for the new accounts, I'm waiting for that kind of zone entry, and we might be getting that. Maybe it continues into Monday. Maybe we get next week is options expiration week, so maybe some games get played with it, but we'll see how it performs. But I like Ring, and I like the pullback that's developing. That's it.
We'll talk to you next week on Your Money.